So the question this week is, how do I choose what to trade based on account size? If 100 or 1,000, or maybe you got 100,000 or a million. So I want to hear from you guys. You've got a lot of experience coming into this. You obviously started with a smaller amount, worked up to a larger amount. How do you think size in terms of the trade size matters when you're thinking about what to trade, which assets to select, and how to think about structuring those trades? And Benjamin, maybe I'll start off with you.
I'll come in. So the first question to think of is basically, am I going to do on-chain or off-chain? Okay. Why that matters is because when you are a small wallet, you also have to think of the fees that you end up paying for all your trades. And if you're just going to do on-chain, then you don't have leverage, right? And if you were doing fully off-chain, then you have, a huge amount of opportunities in one way. But the market has shifted, the volatility has come down across. So, it's gotten tricky for off-chain traders to do multiples as on-chain traders do. But, it's two different ball games when it comes to on-chain and off-chain. So depending on which one you choose or which one you can choose, like if you're based in US and half of Europe, then you don't have access to off-chain anyway, right? For perps trading and so on. And I know that even Amit is not able to access Bybit from UK. If that is the way, then on-chain is your only hope, isn't it? So this is why we've seen a lot of growth on on-chain as well, with a lot of Telegram bots, a lot of other toolings which are coming in and trying to offer better execution capabilities for on-chain traders, including ourselves. We're trying to improve on our execution capabilities on the on-chain side using Panda Terminal, so that more traders are able to make sensible investments, try to ape in as well, increase on volumes. All of that piles up and adds together. So if it is on-chain, let us say it is on-chain, because we all know the centralized side is starting to shrink. So if it is on-chain, now you have a lot of opportunities. You are able to do spot, you're able to do perps, for example, using Hyperliquid, DYDX, Drift. So there's a lot of options. So I think it is about one deciding what type of a trader they are, what is their goals, right? So I have $1,000, it's bull market, I want to make it $1 million, or like I want to make it $100,000.
Why shoot so low? Why shoot so?
So depending on how much time you can spend, depending on what you are looking for using your $1,000, you have to walk back the whole process of how you are going to trade.
Well, yeah. So actually, Amit, come in here a little bit, because Benjamin, you started off saying, listen, regardless of size, you need to think to yourself, do I want to do it on-chain or off-chain? Amit, do you agree that that's kind of the starting point to size at all? If someone has $1,000 portfolio, a 10,000, 100,000, or a million, does that influence that sort of on-chain, off-chain part of the decision, or is there a different starting point?
It does influence a little bit, as Benjamin said, right? If you don't have a choice, as in if you're in the western part of the world, so you don't have a choice to go centralized exchanges. So you have to work with on-chain. But having said that, right, I mean, depending on, if you want to break it down from the size perspective, then you start with, if you have one, that's a general question that everybody asks, right? Because nobody says, I have $1 million, I want to go to 10 million. Those people, you don't hear anybody say that. Generally, the question is, I have $1,000, I want to make 100,000. So most of the times, it's basically, if you're on the western side, you have to go on-chain, and then you have to look for the liquidity side of things. But the way I look at things is, you need to have a smaller goals rather than going 100K can be grown, but that basically what it causes unnecessary pressure on people trying to when one investment make 100x, and that's where a lot of loss happens. So if you break it down into smaller perspective, let's say if you have a 10K account, 1K is too small, to be honest, to grow. It takes a lot of effort and a lot of discipline. So that will take a long time to grow.
And I think 1K, the problem is it's not even about time factor. And yes, it's going to require a lot of discipline. I think the opportunities itself will shrink, because you will have to rely more on luck or some type of insider information. And this is why people end up in cults, think that, okay, this influencer is saying this token is going to 100x, and I just have $100 or $1,000, and I don't have enough time. I can't be sitting in the trenches, so let me throw it over there, and it will basically become 100x.
Yeah, $1,000 is basically, it will take a lot of time and patience to grow. That's for sure. But having said that, it can be done. And now the question becomes, if you are doing on-chain or off-chain. If you're doing off-chain, like if you are going to centralized exchanges, then you have an option of taking a little bit of a leverage, because you don't want to do is basically do 50x and then get bounced out in single trade.
In last cycles, we have seen, we ourselves had algorithms and accounts where we did 40x and so on. So it's been proven that it was possible. This cycle, it has been quite different, I would say. You don't have that type of volatility. It does seem volatile, but it's not really volatile. No, it's either up only. and then it's down only, and then it goes on sideways. The gorilla market. So the period of trending has been shrinking quite a lot. There is an impulse, and then you're basically going sideways. Maybe this is the perks of becoming an adopted market, an asset which is getting global adoption into financial markets, and this is what we have to live with.
So I want to come back to, the initial question was, based on your account size, how do you think about what to trade, even thinking about assets? And you guys are really saying, what I'm hearing is like, no, actually think more about, the goals that you have and how, and I guess I'm going to think about that. I want to start with that because that kind of leads into can you trade being online or offline or on-chain, off-chain. From a goal perspective, what do you think is something you've learned perhaps that's really informed how you think about these goals now? Because I'm kind of curious about that because you do have people that are coming in. Benjamin, you just mentioned they come in, they see some of the historic returns doing 100x, a 40x overnight. And that actually did happen more frequently with more volatility. They see that and they now say, okay, now is my time. And it seems like that's the wrong expectation. And especially if you're trading, I'm thinking, okay, you need to actually be developing a skill, right? Rather than just relying on luck. How do you think about like what an actual goal is? Is it just setting up something? Is it return based? Is it more just, behavioral based of like getting the right behaviors down to kind of build that up? Is it a number based? It's saying I want to take this 10x over 10 years.
I think 10x, putting the number straight away without, given the fact you're starting with a smaller account, right? That itself tells you in a business, if you invest small, it will take longer period and then a lot of discipline. So you have to start from that perspective. So when you're building, let's say a $1,000 account, the way I started is basically learning more about the market I'm trying to trade in and not going randomly about every ticker that comes in and go after that, then throw some $100 in and see what it does. It was basically figuring out what is that 1 to 10 tokens that come up that makes that big move. What are the telltale signs of that? So sit there, observe the market, understand the market you are in, and then you can make a move. Basically, then you can adjust something. So the point being is, you need to start with a measurable metric, as in number of makers, if you're doing specifically on-chain. Because number of metrics, there are certain things that are in your control, there are certain things out of your control. The things that you can see is the number of makers, number of transactions, the size of those transactions. If you start measuring that down, that's your starting point. That will tell you what the market is trying to do. And then you can start coming in from that perspective and say, now I understand how, let's take Solana market. So you on Dex Screener, if you sit and you start looking at things, right? Then over a period of time, you can make an understanding of how that market behaves. What are the telltale signs of a token that is going to move into a territory where you can basically do 2 to 3x? That's the first part. And then the second part is, most of the times what happens is, you get into a good trade, but you don't lock in the profits. That has, for an account to grow, that should change. It should be like, I know there will be tokens that will do 20x, but I might not be able to capture it. So that's where the discipline comes in. So I have an account, I want to grow it to 10x, but I'll start from one point, I'll do 20% lock in the profit and then see how it behaves. If it is still going up, then I'll go chime in again and then make another 20x, 20% on it. So you start locking. If you have a habit of locking in the profits, then you are basically compounding your positions and then you have a chance of basically growing your account faster. But if you are not in a habit of locking in the profits, then it's basically wild rides. It goes up, takes your position, goes down, then you're always beating yourself up. Why didn't I close that position?
So implied in that is that there's some amount of volatility to be able to trade, right? That you've selected sort of a subset of assets that you can look at, you can study, you can begin to understand. I think, both you guys seem to suggest that really anything under $1,000 is going to be very difficult.
The better the tooling you have, whether it is information or, execution or reporting, whatever it is, that is highly important for you to have a chance at making it as a trader.
Mm-hmm. You got to have the money to have the tools to see the data to give you some kind of edge.
Yes, because when I started back in the day, I used to make money and then basically spend it for infrastructure consistently. Used to burn, like I used to, if I had $1,000 earned as a result of some service or whatever, take it, buy up a better server on AWS. It's fine, you lose it. But the next month, if you're doing $5,000, this $1,000 makes sense then. And it gives you that edge. You're able to front run, the competing market makers. You're able to make those steps. So infrastructure matters a lot.
So I just want to kind of summarize that a little bit. You really need, if you're going to be successful at all to be able to build an account, you need a minimum of $10,000. You need to be investing and allocating money to tooling to give you some information so you can develop the understanding of how to see stuff, where to find the alpha that you can actually end up trading. And be able to invest in that. So you got to be thinking about, I would say one thing that's coming out from both you guys is really this more the strategic mindset learned through, I imagine all the years you guys have been doing this stuff. I want to kind of bring this back to the initial question, and I think we can get into more of sort of our regular meat and potatoes of what we cover here. But okay, so if we know that 10,000 is the minimum, then you've got accounts going all the way up to 100,000, a million plus. There's a distinction between, are you going to be doing online or offline, or on chain, off chain, and really a lot of the off chain is becoming much more prevalent in places because of the geo restrictions. That could happen even more. We just saw how Moonshot was launched. It was an on chain for the Trump tokens, which is an interesting story. But I guess coming back to that, let's say you've got a 10,000 is a minimum. Let's talk about a $50,000, $100,000 account. Ahmed, I want to come back to you. What are the assets that you're choosing? You talked about selecting 10. How do you choose those assets for that $100,000 account to trade? Which assets are the ones that you want to use?
I start with looking at the liquidity first, where I can deploy that easily so that I don't have much of a slippage and I'm not getting washed out. So first is basically what is trending, and one is what is the majors in our world. Is BTC is the one thing that will always trade because there is a lot of volatility there, and still you can make 0.5% to 1% on a daily basis because it all adds up. And then it becomes a game of allocation, because you can make up that money that you are spending on chain by taking a bit of a leverage on your off chain account. What I mean is basically you can take your $50,000 and try to play with bigger tokens on chain. And then on the off chain side, you can make it up by taking 1x of a leverage. So then it becomes, you can offset your risk. Then you can start looking at the yields generation, but that doesn't give you much. But from the yield generation side, you can come and lend it, then again borrow it, then use it somewhere else. So then it opens up the opportunity now, because whatever the shortfall you have, you can make it up in terms of very small leverage, but not massive. But then you can start trading both ways. Then you have on-chain execution as well, and then you have off-chain. So in a way, it works as a hedge as well. Plus, it gives you more opportunities to make that money.
Okay, so really the liquidity profile, and then I know you packed a bunch of other things in terms of what you're looking for, but the liquidity profile is really the top part of it. There has to be enough liquidity there to actually be able to trade it, and enough volatility to be able to trade it. Okay. Benjamin, anything that you would add there? Again, going back to this initial question of, how do these different account sizes trade, and what assets should they be looking at? We're talking about volatility and volume. Is there anything else that you would add to that? Is there a different starting
Capital efficiency.
Capital efficiency. Describe what you mean by that.
So when I say capital efficiency, let us talk about both options. One is the off-chain side, right? So let's say you have, $100,000. I'll go from larger wallets to start with, and then come back to smaller wallets. Let's say you have $100,000. Now, you can basically go and buy a basket of assets, take it to Bybit, put it as collateral, and start trading pubs. Now, what is the advantage? You can basically, if you're good enough, and if you're able to make 3 or 4% a month, you are basically generating 3 to 4K of USDT, which, honestly speaking, if you're in Asia, you can live like a king. Okay, that becomes your income of sort. Now, you have to keep in mind your basket of assets that you have taken in will grow in time, right? If you just hold it peacefully for 3 or 4 years, it will always grow in time. And when it comes to the choice of assets, of course, it matters a lot what type of assets you choose. You need to make sure it is either a made in USA type of coins, or assets which have held through time, the test of time, and so on. If you go in that, those are your good collateral. Now, you have converted your 100K as a collateral, and on top of which you're doing lower risk rates, which are earning you monthly income. So 100K or north is a very good way for you to generate a monthly income model, right? And most people, that's what honestly they look for, and then they get greedy and then they lose it all. Now, on the second angle, let's say you're looking more than monthly income, right? Let's say you want to do like 30% or 40% a month. You still have a shot, because if you mess up, you're not your collateral immediately. You are basically having a negative P&L, which let's say you are not able to recover from. And if BTC basically doubles in value or quadruples in value, you'll still be able to sell and cover losses. You've not lost your BTC and these collateral assets. So you're efficiently managing your capital in a way. Indirectly, it is leverage. But if you manage it efficiently, you can capture the upside that comes along with these basket assets, plus take a bit of a risk and try to, grow your portfolio and make a monthly income, or, try to 10x it as well. On the order flow side, on the off-chain side, that is how it is. You have no access to off-chain side, and let's say you're stuck with on-chain. Even then, you have opportunities. Let's say you're just able to buy BTC or WETH, or WBTC or WETH. Go to Aave, put it on, borrow on top of it, get 20% of the value as USDC. Now take that USDC, go to DYDX, or let's say you want to go and gamble that in Solana on meme coins, you can still do it. Now, your collateral over there in Aave is still going to grow, and eventually you can figure out a way to exit that loan and close your position. You would still not miss out the entire upside, because during the bull market, your upside will basically take care of you. And you're using the 20% capital to basically try and play your hand at meme coins or AI tokens or any other narrative-driven trading. So it is much more manageable risk. It is not fully capital efficient as the off-chain side, but it is still far more efficient when it comes to on-chain side. The problem is what a lot of people do is they allocate, and this was something a conversation I had with one of the famous influencers, a budding young trader, but a famous influencer from even the last cycle. And he was a BTC maxi, but in this cycle, he basically went ahead and allocated 30% of his portfolio to shitcoins. Now, the problem is we are not having an alt season like before, right? It's very skewed. You have different narratives popping up and different type of tokens are basically gaining traction. So his 30% of the portfolio is not doing well at all. It's in fact terrible. And he's always having difficulty digesting it, even though he's not actively trading it. Now, why is this a problem? Is because from a BTC maxi mindset, when you're trying to go and explore tokens and you don't have any skill set on it, and when you're relying on Twitter information or insider information, your success rate basically goes down because you don't have a strategy. You don't have a discipline on how you're going to manage it. But if he had just taken all of that allocation into BTC and just taken a 20% of it or 30% of it as a loan, now, even if his entry was at 50K, his portfolio has grown double, and he did not miss out on the BTC upside. And even if his portfolio on the meme coins is down for now, it is still having value. And when he exits all of these things, he'll still be exiting at 90% of the BTC value he would have had, versus the 70% of the BTC value he has now. So it is a lot about capital efficiency and how you are using the toolings, using the instruments available, even if it is just on-chain, and how you maximize your returns. Like, you can also do it this way. You can choose protocols which have not done TGE yet, so potential airdrops. So you try to trade in platforms which could potentially give you airdrops as a result of volumes. You can buy tokens, take it in order to get more rewards. So there's a combination of things that you can do to make sure you are consistently growing efficient in trading side, even if it is you're restricted to on-chain.
It's interesting because as soon as you ask the question that is really kind of top of mind for traders, what assets, I'm getting into this, what assets should I be trading? Should I be going more for the blue chips like Bitcoin, Ethereum, Solana? Should I be looking more at these higher spec ones? You guys immediately start to think more strategically and around a series of other questions. Again, I think kind of arrived at through the experience that you've had over time, right? Of like trying to play in these fields that haven't really panned out, learning how to make your capital much more efficient so that you're accessing the upside, but also being able to generate some kind of, I guess you could call it yield, right, from the trading, which is interesting. So, well, I think there's a lot here. You could summarize. You got to be more strategic. You have to have a certain size of account, 10,000 or more, really. And then as you get higher, you got to be thinking more about capital efficiency, not just about trying to get into those high levered trades, that actually a lower levered trade that we could get into and talk about. So I think it was a good start for the roundtable. I think this is the time to pivot.